Hello, my name is Victoria Burkey, and for the purpose of this course project, I chose to analyze the financial data for LifePoint Hospitals Incorporated. LifePoint Hospitals, Inc. are composed of a collection of 52 acute care hospitals nationwide. They focus on non-urban communities and extending patient care to otherwise underserved populations and geographical areas. After performing a SWOT analysis of the healthcare industry as a whole, several important aspects were discovered. Some strengths of the healthcare industry include, first, the significance placed on quality control initiatives as advised in the Affordable Care Act. Second, the healthcare industry is filled with a variety of educated and competent workers whose focus is on providing patients with the best quality of care that they can. Some threats of the healthcare industry include, first, the impending healthcare policies that may disrupt current trends and procedures. Second, there will continue to be an increasing patient demand while the active workforce diminishes due to an aging population, which could present even more staffing shortages than there already is currently. Some weaknesses of the healthcare industry include rising healthcare costs and impending healthcare reform, which may cause a bit of havoc on the industry. Finally, some opportunities within the healthcare industry include technological advancements, which could help staff serve patients more efficiently and effectively, and integration possibilities in which healthcare organizations can work together to bring more wholesome and patient-centered care. In regards to LifePoint Hospital specifically, some threats include new competition, which could come about with the increasing formation of outpatient services. Also, new healthcare policies, which may interfere with current procedures. And, as it is for the healthcare industry as a whole, the increasing patient demands, while the active workforce diminishes due to the aging population, will continue to be a threat. Weaknesses of LifePoint are quality control that could be difficult to assess and manage across various hospitals nationwide, and that qualified staff are harder to find in non-urban areas, and because there's already a staff shortage, this is even more problematic. Some opportunities for LifePoint hospitals include technological advancements, acquiring more affiliates, and the non-urban outreach, which presents fewer complications for LifePoint in regards to their competitors. Finally, strengths of LifePoint are its reputation, the outreach, and the costs that are spread through over various partner hospitals. LifePoint hospitals have seen a constant and steady increase in its revenue since its inception. Much of that is due to the acquisition of more and more hospitals or assets through the years. For instance, just from 2005 to 2006, LifePoint acquired 6 new hospitals. Taking into account the growth in revenue from 2005 to 2006, it can be assumed that 2007 will bring about an even greater increase in revenue compared to all of the past years. The trend of revenue is an important figure for LifePoint, as it can provide the very basic figures that can help dictate whether or not it is profitable or not. Additionally, revenue can help determine, based too on expenses of course, how much more revenue would be needed to meet a certain goal, or to initiate a new product or service. LifePoint hospitals saw a slight decrease in net income from 2005 to 2006. Net income can decrease for a variety of reasons, but 2 of the reasons that could be there are the increased expenses and or decreased revenue. Because, based on the previous table, it's known that revenue did not decrease, one can just assume then that LifePoint's expenses must have increased. After analyzing LifePoint's income statement, it was apparent that, indeed, expenses increased dramatically, actually by hundreds of millions of dollars from 2005 to 2006. LifePoint acquired 6 new hospitals in 2006, so it is likely that the payment for these played a part in the reduced net income for 2006. However, based on previous financial data, it can be presupposed that LifePoint will still continue to grow and expand. The income from continuing operations rose dramatically from 2002 until it peaked in 2005. However, from 2005 to 2006, income from continuing operations fell considerably. However, similar to the reasoning for net income, the decline is likely due to the increase in expenses that year. On the contrary, cash flow from operations increased from 2005 to 2006. Looking at the total asset changes figure, one can see the steady increasing numbers of total assets through the years. It is especially noteworthy that 2006, which is actually labeled current year in the diagram, is higher than the other years, which may, in fact, be at least partially correlated to the reduced income from continuing operations that year. So net income was increased by more than $73 million in 1 year, which is of critical importance as it signifies the profits of LifePoint after taxes, deductions, expenses, etc. in 2006 as compared to in 2005. In 2006, LifePoint acquired a handful of new hospitals, which added to the total assets of the company. The total assets in 2006 grew by over $413 million compared to 2005, which is about 12.8%. The growth of assets increases the overall value of the company and helps ensure its liquidity. The significant increases in cash flow from continued operations at LifePoint between 2005 and 2006 is a very positive sign in terms of the business's viability. In order to ensure it has the cash flow necessary for operations, this increasing number is significant. LifePoint's ratios decreased on income growth, return on equity, and current ratios in 2006 comparatively to 2005. These ratios are very telling of how the company is doing and should be further assessed. Although LifePoint's return on equity decreased in 2006, it is still better than average considering the industry average for Roe is approximately 8.6%. In other words, LifePoint acquires 18 cents for every dollar of income it earns. The current ratio is utilized to understand where the company would stand should a catastrophic event transpire, such as bankruptcy. In 2006, LifePoint's assets would equate to $4.53 for every $1 of current liabilities. Hypothetically, the industry average is around $2, so LifePoint is again above average in this ratio as well. Overall, LifePoint's mission to bring quality care to non-urban communities is exceptionally valuable and essential to those who cannot afford to travel to urban communities to seek healthcare services. Through the success of their mission and the hospitals they began with, they've been able to extend their outreach to various other areas through the acquisition of various hospitals nationwide. I predict, based on their goals as an organization, as well as their financial data, that they will continue to further expand their services throughout the nation, that they will see a growth in net income in 2007, with the addition of 6 new hospitals, of course, and that they will see a growth in assets. I also predict that investors will see LifePoint as a low-risk opportunity to get involved with and will acquire more stock. Finally, I think LifePoint will continue to hold a noble and trusted reputation among the community and continue to deliver great patient-centered care.